All right, so I get a lot of questions. Dave, what do you think about the interest rates, where they're at today, where they're going to be at tomorrow, maybe even after the new year, or even after the elections? And the truth is, no one really knows where rates are going to be. That's the truth. Okay, even with the best graphs and the best data, there's so many factors involved. And today, what I'm going to talk about is a factor that's kind of uh, driving where the rates are at today, post the Fed fund rate cut of 50 basis points. So you can take a look at this graph. So the way you want to look at this is that as you see this graph increase, okay, what that means is that the mortgage-backed securities, the rates are decreasing. Okay, so that's what the rate that you see being advertised. So those rates are decreasing as you're seeing this graph increase. So you can see up to the on the left side of the screen over here, it says pre-Fed rally pricing, basically built into the rate. So they've already built in the um, the price and adjustment before the Feds even met, because the Feds are so confident that they're going to do a price adjustment, right? So some were thinking it was going to be anywhere from 25 basis points up as high as 50 basis points. And so I think the reason was why we saw the rates increase after the Feds met is, as you can see, what happened is as it started decreasing. And again, when it decreases, uh, it drives interest rates up. So why did it drive up interest rates after the Feds met? Is because they went above and beyond a normal rate cut that they anticipate for. They were looking at a 25 basis points, and they decided to go with the 50 basis points, and therefore increasing mortgage rates. Okay. And so, what's going to happen in the future? Well, certainly what's happened even after that, they announced about 2 weeks ago the unemployment rates and job growth rates. And those results have a lot of impact on the mortgage backed securities. And that's exactly what we trace here. We track the mortgage backed securities. We look at the 30-year, and this is at 5.5 rate on a 30-year 5.5 bond. And we can tell what's really happening on a day-to-day basis, but no one knows because the news can really affect or reports, job reports, unemployment reports, imports, exports. A lot of things have a play in figuring out where the rates are going to go. So, news definitely or results drive mortgage rates on a local level, government in the U.S. as well as what's going on around the world. So there's a lot of factors in that come to play when trying to figure out where the rates are going to be going. But I think if you ask the economists, the mortgage-backed, security gurus in the marketplace, I think the Feds have the mortgage-backed securities exactly where they want them. Meaning, we're probably not going to ever see the 2 to 3% rates because the Feds during that time frame were buying these mortgage-backed securities, which they haven't done in years. Probably 30, 50 years they've actually bought the mortgage-backed securities. So and they don't plan on buying mortgage-backed securities. They only bought that because of what's happening in COVID. So that was a very special time that the government was buying mortgage-backed securities, and we're not going to see those probably in my lifetime, your lifetime, if you're watching this, if that's ever going to happen again. Okay, that was a very rare situation. But if you look back in history, the last 3, 4, 5 years post COVID, uh, economists were stating that it was the 30-year fixed mortgage-backed security is going to be right around that 5.5 to 6%. Now, there's a lot of variables on that because that's just bare. That's just what the bonds are trading at. That's not actual the interest rate because there's pricing that's built into that, such as FICO scores, the size of your loan to value ratios, your debt to income ratios, first time buyer, non first time buyer. So there's a lot of factors involved to come up with the actual interest rate. But if you want to look at the bare bones, where the rates are trading at on mortgage-backed securities bond in the bond market, this is it here. So last week we saw the rates kind of shoot up a little bit, and then towards the end of the week we saw them dip down. Um, but they're very volatile right now. It's not like it was in 2020, 21, 22, where the feds were buying all these mortgage-backed securities and they just bought them all. That's why rates were steady, low. But right now, we're dealing with institutional investors buying these mortgage-backed securities. So it's just depending on what's being reported that day. If you have any questions with this, feel free to give me a call. I hope this makes sense and make it a great day out there. Thank you so much for watching.